200 failures. That's how many dry holes Robert O. Anderson drilled before he finally struck oil in New Mexico. 200 times he watched money disappear into the desert floor. 200 times people told him he was crazy. And then on the 201st attempt, he hit a field that would produce 250 million barrels of oil. And get this, finance the discovery of North America's largest oil field. Today, that same New Mexico desert produces over 2 million barrels of oil every single day. Well, if you're not sure how much that is, picture this. An Olympic swimming pool, well, that holds about 660,000 gallons. New Mexico fills 477 of those swimming pools with oil every day. And that makes this state, New Mexico, the second largest oil producer in America, behind only Texas. But here's what makes New Mexico different from every other oil state. They save half of everything that they earn. They've built a $64 billion permanent fund. Now, let me say that's only partially correct. I understand that according to fiscal policy sources from November of 2025, the land grant permanent fund is worth approximately $33 billion, not $64 billion. But when you combine the land grant fund, which is $33 billion, with early childhood education and care fund, that's another $10 billion, and the other state pension or permanent funds, that gets to be closer to the actual number. But anyway, they use that money to pay for universal free childcare, tuition-free college, and better teacher salaries. Now, New Mexico took its oil wealth and bet it all on its children's future. And then, interestingly, Washington cut that funding by what's estimated $5.1 billion. Now, again, that's an estimate. The federal royalty cut went from 16.7% to 12.5%, and it's estimated that that's going to cost New Mexico $5.1 billion by 2050. And that's an estimate by Brian Prest. So he's with At Resources in the Future. So anyway, I'm Mark Roach. I'm a petroleum engineer. I've been a deal maker 30 years in this business, and this is FutureWise Energy, an independent channel. Today we're going to dive deep on New Mexico because this story has everything. I mean, wildcatter persistence, geologic fortune, smart policy choices, and then the federal government possibly undercutting a state that did everything right. I'll let you decide. Now let's start at the beginning. New Mexico's story, well, they started producing commercially in the 1920s. The first successful natural gas well was completed in 1921, right around the time that geologists discovered the Permian Basin. Now, the Permian Basin is a 75,000 square mile geological province. Some people say it's 85, but if you're just tuning in here, it's quite large. It stretches across West Texas and southeastern New Mexico. And the name comes from Permian age rocks that were deposited, we're told, 250 to 300 million years ago. And it would eventually become one of the most prolific petroleum provinces on the planet. But here's the thing. New Mexico's side of the oil basin, or of the basin, developed more slowly than the basin was developed in Texas geologically. And the reason? Well, actually not geologically, from the surface ownership patterns that, Texas had mostly private land, which means if you wanted to drill, you negotiate with the rancher and get to work. In New Mexico, which had massive federal and state land holdings, that means there were bureaucratic barriers, permits, reviews, environmental assessments. While in Texas, wildcatters punched holes as fast as they could raise money and work with the ranchers. New Mexico operators had to wait on federal permission from Washington. And the difference, well, it still shapes everything about this story. The mid-20th century belonged to the wildcatters. These were independent oil men, willing to risk everything on speculative drilling ventures, and they embodied the American entrepreneurial spirit. Drill a dozen dry holes, go broke, scrape together more money, then try again. And most of them failed. And the ones who didn't fail, well, they built empires. The wildcatter philosophy came down to a few core beliefs. Trust your geologic intuition over conventional wisdom. Build the financial resilience to absorb multiple failures. Hold long-term conviction in specific prospects, even when everyone else says you're wrong. Be willing to drill where major companies wouldn't. And use personal financial risk rather than corporate capital, because when it's your money on the line, you make different decisions. No figure looms larger in New Mexico oil history than Robert O. Anderson. His story is the story of the state's oil industry. Anderson was born in 1917. He arrived in New Mexico in the early 1940s with dreams of striking it rich. What he found was 16 years of failure. Between 1941 and 1957, Anderson drilled 200 dry holes. 200 times he bet on a location and lost. 200 times he watched his money disappear. In 1942, he bought land for something called the Empire Abo Field near a small town called Artesia, New Mexico. And here's where it even gets a little more interesting. He can't drill it. He held that land for 15 years of paying lease fees, 15 years of people telling him he was sitting on worthless dirt, 15 years of waiting while other operators rushed from prospect to prospect. In 1957, Anderson finally drilled Empire Abo, and he struck oil. Not just any oil. This field ultimately produced 250 million barrels. At today's prices, that's worth roughly $15 billion of oil from just one field that everyone told him was worthless. But Anderson didn't stop there. He used those New Mexico profits to found a company called Atlantic Richfield. You might know it as, or have known it as ARCO. It became the sixth largest oil company in America. And in 1967, just 10 years after the Empire Abo, Anderson's team discovered Prudhoe Bay in Alaska. That's North America's largest oil field, 13 barrels of oil. Think about that. New Mexico oil money earned a man who failed 200 times financed the discovery of Alaska's oil wealth. Anderson went on to become one of America's largest individual landowners and a prominent philanthropist. But it all started with 16 years of failure in the New Mexico desert. Anderson's story, well, it mirrors other famous wildcatters. In Oklahoma, there was Tom Slick, known as Dry Hole Slick, and Mad Tom before he finally discovered the Cushing Drumright field. The pattern repeats. Fail repeatedly, keep drilling, and eventually the geology rewards persistence. The independent spirit built the American oil industry before corporate consolidation took over, and it's worth remembering because New Mexico is about to need that same persistence again. Let's jump forward to the modern era. New Mexico's oil industry experienced a second birth starting around 2010. The technology that changed everything was hydraulic fracturing combined with horizontal drilling. You've probably heard of fracking. Now here's what it actually means for New Mexico. Traditional drilling goes straight down into a reservoir and pulls oil up. The problem is a lot of the oil is trapped in tight rock formations that don't flow very easily. Horizontal drilling lets you drill down and then turn sideways and drill horizontally through a thin layer of oil-bearing rock, sometimes for 3 miles or more. Then hydraulic fracturing pumps fluid and sand into that horizontal section at high pressure, cracking the rock and creating pathways for oil to flow. Combine these two technologies and suddenly you can extract oil that was completely unreachable 20 years ago. This technology unlocked the Delaware Basin, which is the western sub-basin of the Permian, and it straddles the Texas-New Mexico border. The key geological discoveries include the Wolfcamp Formation. In 2016, the U.S. Geological Survey assessed the Wolfcamp at 20 billion barrels of recoverable oil. That was the largest unconventional oil assessment in U.S. history at the time, unconventional being shale. Then there's also the Bone Spring Formation, with additional billions of barrels in multiple stacked pay zones. Stacked pay means on top of each other. And then just last month, in January 2026, the USGS announced a new assessment of the Woodford and Barnett shales at 28.3 trillion cubic feet of natural gas and 1.6 billion barrels of oil. So the production numbers, they tell a story better than anything else. In 2019, New Mexico produced approximately 900,000 barrels of oil per day. By 2024, 5 years later, the number had climbed to over 2 million barrels per day. Production more than doubled in just 5 years. New Mexico now accounts for just over 15% of total U.S. crude production. If New Mexico were a sovereign nation, it would rank 14th globally in oil production, ahead of countries like Kuwait and the United Arab Emirates. Here's where it gets complicated. Almost all of this growth happened on federal and state lands. Remember that land ownership difference that I mentioned earlier between Texas and New Mexico? Well, it matters now more than ever. Onshore federal land production hit 1.7 million barrels per day in 2024. That's a record. New Mexico accounts for 79% of all federal oil production and 55% of all federal gas production in the United States. 6 times more production than 2008 levels on federal lands. The New Mexico side of the Permian leads oil output growth from all federal lands nationwide. The geographic concentration is remarkable. 2 counties produce nearly all of New Mexico's oil, Lee County and Eddy County. Together, these 2 rural counties generate 29% of the entire Permian Basin's output. Eddy County is now the fastest growing county in New Mexico, driven entirely by the oil boom. The combined population, well, it's about 140,000 people. That's smaller than most mid-sized cities, and they're financing programs for the entire state of 2 million residents. Now let's talk about what New Mexico does with all this money, because this is where the state truly stands out. When New Mexico became a state in 1912, it established something called the Land Grant Permanent Fund. This wasn't an accident. The federal government granted New Mexico millions of acres of land when it achieved statehood, with the understanding that revenue from those lands would support public institutions, especially schools. Today, the land grant permanent fund is worth, they say, $64 billion. And that makes it the second largest state sovereign wealth fund in America, behind only Alaska's permanent fund. The revenue sources include oil and gas royalties from 13 million acres of state trust lands, 50% of federal royalties paid on federal lands within the state, and investment returns on the principal. Here's the key. The state constitution limits how much can be withdrawn each year, maximum 5% of the trailing 5-year average. This prevents politicians from raiding the fund during good times, and it forces long-term thinking. Right now, the annual distribution comes to approximately $836 million flowing into the general fund, making it the second largest revenue source from the entire state government. Compare this to Texas. Texas produces more oil than New Mexico in absolute terms, but their revenue management approach is completely different. New Mexico directs about 50% of oil and gas revenue to permanent funds. Texas directs about 20%. New Mexico directs 50% of the general fund for current spending. Texas directs 80%. What does this mean in practice? New Mexico has a lower budget volatility. When oil prices crash, Texas scrambles to cut spending or raise other taxes. New Mexico has a cushion. More importantly, New Mexico prioritizes generational wealth transfer. Today's extraction finances tomorrow's children. In November 2022, New Mexico voters did something unprecedented. They approved Constitutional Amendment number 1, which redirected oil wealth specifically to early childhood education. This was the first time any state constitutionally directed or dedicated permanent resource wealth to universal pre-K and to child care. The amendment creates an additional 1.25% annual distribution from the permanent fund beyond the existing 5%. Of that new money, 60% goes to early childhood education and care. The remaining 40% goes to other educational purposes. The program's launched in December 2025, just 2 months ago. And here's what New Mexico now offers: universal free childcare for families earning up to 400% of the federal poverty level. That's families earning up to about $120,000 per year for a family of 4. Tuition-free college programs, universal free school meals for all public school students, significant teacher salary increases. The thinking behind this is straightforward. Oil is a finite resource. Eventually it runs out. What you do have left when the wells stop flowing, well, if you spent everything on current consumption while they were producing, then you're left with nothing. If you invested in human capital and you have educated, skilled workforce that can build a diversified economy out after the wells stop pumping. Early childhood education years yields documented long-term returns, and kids who attend quality pre-K have better educational outcomes, they say. Higher lifetime earnings and lower rates of incarceration and social service dependency. So New Mexico's betting that investment of oil wealth in 4-year-olds today will pay dividends for 80-year-olds someday. Well, now let me show you the full picture of how New Mexico collects revenue from oil and gas. The state levies an oil emergency school tax at 3.15% of production value. Natural gas emergency school tax runs at 4%. Severance tax is now capped at fiscal year 2024 levels of $1.145 billion flowing to the general fund. State royalties on newly issued prime leases hit 25% in 2025, up from 20%. And federal royalties, which we'll get into in a moment, are now running at 12.5% under the new Trump or this Trump 2, the Trump administration that's currently in office. And that 12.5% today is down from 16.7%. Add it all up, and New Mexico collects approximately 20% of total production value through these various mechanisms. Oil and gas revenues represent 25 to 30% of the state's general fund. When you include indirect effects like jobs, business taxes, and economic activity, 36% of the general fund ties back to the industry. Total annual state revenue from oil and gas exceeds $4 billion. The 2023 to 2024 period saw record oil production generate a projected $3.5 billion budget surplus for the year 2024-2025. The surplus funded the expansion of social programs while also building permanent fund reserves. New Mexico was hitting on all cylinders. Well, and then Washington changed the rules. To understand New Mexico's vulnerability, you need to understand federal land ownership. And this is where the story turns. New Mexico has 24.67 million acres of federal land. That's 31.7% of the entire state. Now, that 31.7 figure, I've seen some numbers in the ballpark of that. So don't put a fine-tooth pencil on that number, but it's close. It's in that neighborhood. And that looks like it makes New Mexico about the 10th most federally owned state by percentage. Now, but here's the critical distinction. States with higher federal ownership, like Nevada, which the federal owns 80%, or Utah, where they own 63%, they don't produce much oil. States that produce a lot of oil, like Texas, well, there's only around 2% of federal ownership in Texas, or North Dakota has about 4% federal ownership. And they have minimal federal exposure. New Mexico has maybe the worst of both worlds, a massive oil production and massive federal land dependency. 65% of New Mexico's oil production occurs on federal lands. Federal policy changes that barely touch Texas devastate New Mexico's budget. This isn't a minor difference. This is structural vulnerability baked into New Mexico's geography. The Bureau of Land Management, or BLM, manages about 13 million acres in New Mexico, roughly half of the federal land in the state. Nationally, the BLM oversees 244 million surface acres and 712 million acres of subsurface mineral estate. Nearly all of that land sits in western states. The BLM's decisions on royalty rates, lease terms, bonding requirements, and environmental review processes directly and immediately impact New Mexico's state budget in ways that are unimaginable for Texas or North Dakota. Which brings us to the single most consequential federal policy change for New Mexico recently, the Trump administration's royalty rate rollback. In July 2025, Congress passed the One Big Beautiful Bill Act, which reduced federal royalty rates from 16.7% back down to 12.5%. Some context here. 12.5% was the rate from 1920 to 2022. That's 102 years at the same rate. In 2022, the Biden administration raised it to 16.7% to capture more value from public resources during the shale boom. Now, the Trump administration reversed that increase. Well, what does that mean for New Mexico? Well, according to analysis by economist Brian Prest at Resources for the Future, New Mexico will lose $1.7 billion by 2035 and $5.1 billion by 2050 from that policy change. So I'm presenting the numbers from the perspective of the state of New Mexico here. All those numbers are somewhat based on assumptions of oil price and production rates. But here's a quote from Prest, who put those numbers together, that New Mexico's impact is getting impacted way bigger than Wyoming, Colorado, or North Dakota. And that's just because of where the action is on this new development. The losses are already materializing. A January 2026 lease sale covering 20,400 acres across 30 parcels in New Mexico generated strong bids. The average was $16,000 per acre. But at the reduced royalty rate, New Mexico lost $110 million from that single lease sale compared to what it would have received at the 16.7% rate. Approximately $600 million has already been lost from leases that were sold in July 2025. So here's the pricing paradox that makes this frustrating to New Mexico, which simultaneously raised its own state land royalty rates to 25% in 2025, up from 20%. So now we have this situation. BLM federal lands charge 12.5% royalty. Private landowners typically charge 18 to 25% royalty. New Mexico state lands charge 25% royalty. The federal government now charges less than your local rancher for publicly owned resources. This is a subsidy to industry disguised as a tax policy. Now, the Trump administration didn't stop at royalty rates. They've dramatically accelerated federal oil and gas leasing. In 2025, the BLM approved 6,027 new oil and gas permits. That's more than any year in the past 15 years. Massive lease sales rolled out across New Mexico, Wyoming, and Colorado. The One Big Beautiful Bill Act mandates rolling quarterly lease sales through 2040. In December 2025, 80 million acres were offered for offshore drilling in the Gulf of America. Now, some of you may know that as the Gulf of Mexico that have worked in the industry forever, and we're talking about the same place. Now, the administration also streamlined regulations. Bonding requirements were reduced, making it easier for operators to abandon wells without cleanup. Permitting processes were expedited on federal lands. Environmental review requirements under NEPA were shortened. Focus on methane emissions and flaring was reduced. For the industry, well, this is a favorable environment. Faster permits, lower fees, less oversight. For states like New Mexico that depend on federal revenue sharing, it's a double-edged sword. More drilling, but less money per barrel drilled. There's one more proposal that deserves attention, even though it hasn't passed quite yet. In June 2025, the Senate included provisions in a tax bill to set up 3 million acres of BLM and Forest Service land. The purpose is to help pay for Trump tax cuts. Projected revenue is $10 billion over 10 years. Target states include New Mexico, Nevada, Utah, Arizona, Wyoming, and other western states. This is the most dramatic shift in federal land policy proposed in modern history, converting public assets to private ownership to finance tax reductions. For New Mexico, this could mean loss of public access to hunting, recreation, and cultural sites. It could mean reduction in federal and mineral estate available for future leasing. And it would permanently alienate land held in trust for all Americans. The proposal faces strong opposition from conservation groups. from outdoor recreation advocates and many Western politicians on both sides of the aisle. But it is in the legislative pipeline, which is why I'm mentioning it here. Now let's talk a little bit more about the political tension here, because it's genuinely fascinating. New Mexico's Governor Michelle Lujan Grisham is a Democrat. She's presiding over an unprecedented oil boom, while the Trump administration policies that reduce the state's take from that boom. And she's committed New Mexico to aggressive climate goals, including the nation's strictest flaring rules with a 2% limit by 2026. But her budget depends on the industry responsible for 53% of the state's greenhouse gas emissions. So here's the contradiction laid bare. Climate commitments push toward less drilling. Budget reality requires more revenue from drilling. Federal opposition means fighting royalty cuts that reduce revenue. Environmental goals conflict with every industry funding environmental the very industry that is funding these environmental programs. The state is already seeing impacts. Revenue contracted 1.6% in recent months, and that was the first decline since the COVID pandemic. The Universal Free Child Care Program, which cost $160 million annually, is under budget scrutiny. Court-ordered education improvements for Native American students are at risk. Teacher salary increases may be threatened by revenue volatility. Governor Lujan Grisham's response includes raising state royalty rates to 25% to offset federal losses. She ended the state land sales moratorium to generate more revenue. She's exploring legal challenges to federal royalty rate reductions. But there's only so much a state can do when 65% of production sits on federal lands. So the irony is thick. The oil boom continues under Trump and his pro-drilling policies, but his royalty cuts undermine the state programs that make New Mexico's model really work. Let me give you a snapshot of the current market conditions as of, February 2nd, 2026. West Texas Intermediate crude oil sits at approximately $62.25 per barrel. There was sharp volatility recently with prices dropping 5% from multi-month highs near $66.60. The driver, the U.S.-Iran diplomatic talks diffused some of the war premium that had been propping up prices. Then looking at the technicals, there's the double top pattern at $66 resistance that confirmed a bearish reversal. Support levels at 61.50 and then 60 and then 58.50. The analyst consensus for 2026 average price is $58.72 per barrel. Fundamental drivers include a projected global supply surplus of 3.5 million barrels per day in 2026. OPEC Plus maintained March quotas with no supply reduction. The strong dollar pressures commodity prices. Is it going to stay strong? Well, also the Chinese are demanding, and their demand is remaining rather modest and is below pre-COVID trends. Brent crude trades around $70.81, maintaining a typical Brent WTI spread of about $7.24. Natural gas tells an even more dramatic story. Henry Hub currently sits at approximately $3.62 per million BTU. That's million British thermal units, which happens to be the standard unit for natural gas pricing. But look what happened in January. Winter Storm Fern hit January 19th to the 28th, and natural gas prices spiked to over $30 on January 23rd. That's the highest since 2022. The price doubled in 5 days, which was the largest one-week rally since 1990. Why? Well, sub-freezing temperatures reduced production across Texas and New Mexico. LNG export deliveries dropped 48%, During the storm week, supply crunch met demand spike. Producers rushed to hedge at elevated prices, with hedging activity increasing sixfold. And then it collapsed. In just 10 days, pricing dropped back 88% from its peak. So we're now back near normal winter levels. The EIA forecast average prices of $3.50 in 2026, rising to $4.60 in 2027 as LNG export demand growth outpaces supply growth. Let's look at drilling activity. The Baker Hughes rig count for the week ending January 30th shows 441 active rigs nationally. That's unchanged from the previous week, but down 61 rigs from a year ago, a 12.9% decline. Gas rigs sit at 125, actually up 27 from a year ago. Total oil and gas rigs, 546, down 36 year over year. The Permian Basin specifically has 242 active rigs, and that's down 61 from January 2025. Despite the decline, the Permian remains the most active basin in the United States by a wide margin. Here's what's interesting. Production hasn't declined with the rig count. U.S. crude production sits at 13.7, almost 13.8 million barrels per day. That's only 58,000 barrels a day below the all-time high. 2024 set a new annual production record even as rig counts fell. How? Well, with efficiency gains. Drillers are doing more with less. Longer lateral drilling, some exceeding the 3 miles that I mentioned earlier. Improved completion techniques with more frac stages per well. Better geologic targeting using analytics and subsurface modeling. Multi-well pad drilling efficiency that reduces surface impact and costs. The rig count decline doesn't signal production collapse, and it reflects an industry that's disciplined. Companies are prioritizing returns over volume growth. Shareholders want cash flow, not maximum production. So where does this leave New Mexico? Well, the success story is real. New Mexico transformed from and also ran to the second largest producer in America in just 15 years. They built a $64 billion permanent fund from resource wealth. They pioneered early childhood education funding from oil revenue. They implemented the nation's strictest environmental regulations on flaring. They balanced production growth with long-term fiscal responsibility. The vulnerability is also real. 31.7% federal land ownership creates policy exposure that no other major producing state faces. 65% of production on federal lands amplifies every federal policy decision. The Trump royalty cut threatens maybe $5.1 billion in lost revenue by 2050. A small population of 2 million people means extreme per capita dependency on this oil revenue. Climate goals conflict with this budget reality. Robert O. Anderson failed 200 times before striking oil at Empire Abo in 1957. His persistence paid off, financing ARCO and Alaska's Prudhoe Bay. Today's New Mexico persistence in responsible resource management deserves similar rewards, but federal policy does threaten to turn the state's prudence into a cautionary tale. New Mexico did everything right. They learned from Anderson's persistence. They saved instead of spending, and they invested in their children's future. They built constitutional protections for long-term wealth. They implemented environmental safeguards. And none of that protects them from decisions made in Washington when 65% of your oil sits on federal land. Your state's future still depends on the people who don't live there, who don't vote there, and who may have very different priorities. The wildcatter spirit that built the industry isn't just about drilling for oil. It's about betting on the long game, taking calculated risk, enduring failures, maintaining conviction when everyone else says you're wrong. New Mexico made that bet. They bet saving oil wealth would build a more resilient future than spending it. They bet that investing in children would pay off long after the wells run dry. They bet that responsible resource management was smarter than boom and bust spending. The question now is whether Washington will let them collect on that bet or whether federal policy will drain the rewards before New Mexico's children ever see them. The state has transformed from dry holes to Delaware Basin dominance, from Anderson's 200 failures to 2 million barrels a day, from constitutional protections written in 1912 to early childhood programs launched in December 2025. That's New Mexico's oil story. Wildcatter persistence, smart policy choices, generational thinking, and a vulnerability to federal decisions that could undermine it all. I'm Mark Roach. This is FutureWise Energy. The lesson here goes beyond New Mexico. It's about whether states that do the right thing with resource wealth get rewarded or punished, whether long-term thinking beats short-term politics, whether Washington recognizes that public resources deserve fair returns. New Mexico placed its bet. Now we have to wait and see if the House lets them win.